So this is the trap. You can own hundreds of stocks on paper, yet your results still lean hard on a small group at the top. And if that crowded trade cracks, you don't discover the risk in theory. You feel it in your account. Let's strip away the comfort story around owning the market. Then look at what real diversification actually asks from you. Start with the simple part. A market cap weighted fund gives more space to bigger companies. If one company is worth far more than another, it gets a larger slice of the fund. Then if that large company keeps rising, its weight grows again, which means success feeds more influence back into the same names. Think about a mall with 500 stores. On paper, that sounds spread out. But if a handful of giant stores take up most of the floor space and bring in most of the traffic, the mall's health depends more on them than the small shops in the back. That is close to how many index investors misunderstand the S&P 500. The mistake starts with counting names instead of measuring weight. You look at a long list of holdings and assume risk is spread evenly. It usually is not. A few large holdings can drive a big share of returns, and when that happens, the fund may act less like a broad basket and more like a concentrated position wearing a diversified label. This clicked for me when I stopped asking, how many stocks are in the fund, and started asking, which stocks can actually move the outcome? That is the better question. Because diversification is not about how many lines appear on a statement. It is about how much damage any one part can do when the cycle turns against you. Now, here is where people get lulled to sleep. During a bull market, concentration often feels smart. The winners keep winning, the biggest firms keep growing, and the index looks strong. So investors read that strength as proof of safety, when really, they may just be watching momentum lift the same crowded leaders even higher. And there is a second layer people miss. When the same giant firms shape index returns, they also shape how investors think about risk. Different sectors may still look different by label, but if the market keeps leaning on the same handful of dominant businesses, your portfolio can still hinge on one theme, one style, or one part of the cycle. That does not mean index funds are bad. It means you need to know what you own. Broad market access is not the same as balanced risk, and market exposure is not the same as diversification. Once you see that difference, the next question gets more useful. If stock count is only one layer, what does real diversification actually look like when you build for durability instead of headlines? Real diversification starts with a different question. Not, how many stocks do I own? But, what actually drives my risk? If several holdings rise and fall for the same reason, then you may own many things while still depending on one engine. That is not spread. That is clustering. You need to think in layers. First is stock count, which is the layer most people stop at because it is easy to see. Second is weighting, which tells you how much influence each holding carries. Third is asset class mix, which tells you whether your whole plan still lives or dies with the same broad market force. A lot of portfolios look diverse at layer 1 and fail badly at layers 2 and 3, which is why the label feels safe right up until stress exposes the structure. This is where weighting starts to matter in a practical way. A market cap weighted fund naturally gives larger firms more room, while an equal weight approach spreads influence more evenly across holdings. What this means is not that one method is always right and the other always wrong. It means the portfolio will behave differently. If you reduce single-name dominance, you usually get less dependence on the very biggest firms, and you give smaller companies more say in the outcome. That shift changes the ride. You may get less of the top-heavy surge when mega-caps lead the market, but you may also avoid building a core position that quietly depends on the same few names everyone else already depends on. Think about this principle. Real wealth is usually built by surviving many cycles, not by looking smart in one crowded stretch. And there is a wider point here. One stock fund, even a famous one, is still one asset class. It is still equity risk. So if your whole plan sits inside one index and you call that full diversification, you are mixing up convenience with balance. Convenience is fine. Confusion is not. The better habit is to audit the structure before the market does it for you. Start with the top holdings. Look at the first 10 names and ask how much of the fund they control. Then check sector weight, because concentration can hide there too. After that, check overlap across funds. This part matters more than most investors think because many portfolios hold several funds that look different by name, but still own many of the same large stocks underneath. That is one of the most common mistakes I see. People add more funds and feel safer because the account looks fuller. More tickers, more labels, more wrappers. But if those funds keep circling back to the same dominant companies, then you did not spread risk. You stacked it. A simple way to think about this is a garden. If you plant 500 seeds in one patch of soil, one storm can still hit the whole patch. One drought can still hurt everything at once. The number of plants helps less than you think if the same weather controls all of them. So build from purpose, not from fund names. Decide what role each holding plays before you buy it. Is it your large company exposure, your smaller company exposure, your bond exposure, your international exposure, or just another version of what you already own? That one habit changes a lot because it moves you from passive assumption to active understanding. Index funds can still be useful tools, but tools have structure, and structure shapes outcomes. So the shift is simple. Diversification is about weighted risk, not headline stock count. On your next portfolio review, pull up your top 10 holdings, your sector mix, and the overlap across your funds. Then ask one hard question. If this small group struggles, how much of my result goes with it? Once you start reading structure instead of labels, market moves feel less random and your decisions get calmer. If you want the next layer, watch the next video on how billionaires use concentration on purpose instead of drifting into it by accident.